Expert tips for success. Based on the experience of professional Forex traders and common mistakes they've seen traders make, here are some potential common mistakes that Forex traders make. 1. Overtrading and taking too many positions. 2. Using too much leverage and risking too much. 3. Not having a trading plan and blindly entering trades. 4. Ignoring risk management strategies, such as stop-loss orders. 5. Focusing solely on profits and ignoring potential losses. 6. Not paying attention to the news and economic events that can affect the market. 7. Trying to predict the market rather than following trends. 8. Lack of discipline and not following their trading plan. 9. Emotional trading and making impulsive decisions. 10. Trading without proper education and knowledge of the market. 11. Not testing and evaluating strategies before trading with real money. 12. Chasing after losses and trying to make up for them with riskier trades. 13. Holding on to losing positions for too long. 14. Failing to adapt to changing market conditions. 15. Trading with too small or too large of a trading account. 16. Using too many technical indicators and analysis tools. 17. Being too optimistic or pessimistic about the market. 18. Trading based on rumors and hearsay. 19. Not having a clear exit strategy. 20. Trading too frequently and not letting positions mature. 21. Failing to keep track of trading records and results. 22. Overconfidence and not recognizing potential risks. 23. Not using a trading journal to record their trades and mistakes. 24. Not diversifying their trading portfolio. 25. Following other traders blindly without doing their own research. 26. Not having a clear understanding of the currency pairs being traded. 27. Ignoring the impact of geopolitical events on the market. 28. Not having a long-term trading plan and goals. 29. Trading during high volatility times without a proper strategy. 30. Not seeking professional advice or mentorship when needed.